I would now like to review exercise 19-19, and again, it's the same scenario as exercise 19-17 with just another consideration in calculating fully diluted earnings per share. On December 31st, 2020, Berkshire Inc. had 200 million shares of common stock and 3 million shares of the 9% $100 par value cumulative preferred stock issued and outstanding. On March 1st, 2021, Berkshire purchased 24 million shares of common stock as treasury stock. Berkshire issued a 5% common stock dividend on July 1st, 2021. 4 million treasury shares were sold on October 1st. Net income for the year December 31st, 2021 was $150 million, and the income tax rate is 25%. Also, its outstanding at December 31st was incentive stock options granted to key executives on September 13, 2016. The options are exercisable as of September 13, 2020 for 30 million common shares at an exercise price of $56 per share. During 2021, the market price of the common average is $70 per share. In 2017, $50 million of 8% bonds are convertible into 6 million shares were issued at face value. Now, the basic earnings per share is exactly like the basic earnings per share in exercise 19-17. Now, for the diluted earnings per share, we have to consider all potential shares that could be outstanding. Now, there are two types of potential shares that could become outstanding. The first is the stock options, which are outstanding as of the end of December 31st, but we want to give a diluted earnings per share picture as if they were exercised. In addition to that, we have a new example of fully diluted earnings per share, and that is the conversion of bonds. We will include as potential shares that could be outstanding, that is the $6 million shares that can be converted instead of the $50 million 8% bonds. Currently, the company has $50 million of 8% bonds, but they do have a convertible feature, which the bonds could be cashed out for 6 million common shares issued at face value. So, for the stock options, we're going to use the treasury stock method, but let's go through this scenario. Well, first, the beginning shares in 2021 was 200,000. Then they purchased 24 of their own shares, which are treasury shares, and that happened in March, which was 10 months divided by 12 months. And they also sold some of the treasury shares in October, 4 million, and they were outstanding for 3 months out of a 12-month period. Okay, now we know there was also a 5% dividend, so we have to go back from the beginning of the year to the time the dividend was declared, and in this case you would take the 200 times the 105 for $210 million, and then you would take the 24 shares times 105, which is subtract 21 million, and then the new shares, the treasury stocks they sold, created new common shares, and that would be 4 with 3 divided by 12, for it happened in October, which is 1. Now, the assumption of the exercise of the options. And we can go back to a problem that we recently did to just review the purchase of treasury stock. They used this process where they would take the money they received from the exercise of the options. There were 30 million shares that could be purchased with the stock options, and they could be purchased for $56. So that gave them $1,680,000. And the average price for the year was in 2021 was $70. So what they would do is they would have 30 million shares outstanding as the result of executives exercising the privilege of purchasing the stock at $56, the exercise of their options. And they would take that money and they would repurchase treasury stock, and at the average market price of $70. So we know you take the 30 million minus the 24 million they can purchase with the proceeds they received from the stock options, and the difference is 6 million. So potentially only 6 million shares are outstanding. And you can see this right here. And refer to exercise 1918 for how that $6 million was calculated. Now, I also brought to your attention in reading the problem, there are 50 million of 8% bonds outstanding that has a conversion into 6 million common share option. So there are potential shares that can be outstanding, which we use for diluted earnings per share. But we have to make an adjustment to the net income. The adjustment would be the 150 million in net income less the 27 million in preferred dividends. But now we have to actually make an adjustment, because if we assume the bonds are converted to common shares, bonds pay interest. If we assume they have been converted, then we have to consider, well, the interest will no longer be included in the net income calculation, because we're assuming that the bonds were converted at the beginning of the year. So in order to do that, we need the after-tax interest savings. Well, the bonds pay 8% on $50 million. So that's $4 million. So to calculate that, you would take the 50% times the 50 million times the 8%, and we want that net of tax. And the net of tax would be 100% minus the tax rate given to us in the problem of 25%. So the after-tax savings, because the interest would not be included in the net income, so we would take 150 minus the 27, include the after-tax interest savings to give us 126 million. So 126 million divided by, and then of course we would have to take the conversion of the bonds, which we know are 6 million. So if you add that across of the number of weighted shares outstanding, because the conversion of bonds is considered to occur at the beginning of the year, gives us the weighted shares outstanding of $202 million. So we have 126 million divided by 202 million to give us 62 cents of diluted earnings per share. Because it is less than the basic earnings per share of 65 cents, we would report the diluted earnings per share.